Good morning from unseasonably warm and very rainy Chicago, where I'm anxiously awaiting tonight's kickoff of the Chicago Bears San Francisco 49ers football game. The 11-4 Bears are sitting pretty on top of the NFC North, and people in Chicago are going to be glued to our TV sets tonight just to see how far our Bears can get into the playoffs. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money biweekly podcast. Today's date is Sunday, December 28th, 2025. Let me take a minute to wish everyone a happy new year. I hope your holidays, however you celebrate them, have been wonderful. We really appreciate your viewership. We appreciate the opportunity to show you the unique tools that we have developed here as a result of my being in the business for 43 years. We hope to continue sharing our ideas with you in 2026. So, Happy New Year to all. In today's podcast, our focus is going to be on the benchmark S&P 500, which is currently trying to make a definitive breakout higher above its recent range that we've been locked in since about the middle of October. We're facing important psychological overhead resistance at 7,000. And in addition, those that follow us here every week on YouTube may recall back in July when the S&P was breaking out and making fresh highs, we talked about an upside target of 69.50. So we're there now, and we're just under 7,000. When the market has a big move, like we've been up, 45% now since April, when the market has a huge move like this and starts to hit upside targets and comes into these psychological resistance levels, it starts to drift sideways, which is what it's doing right now. It's kind of a distribution period. It's gathering energy for the next move. So the key here is to try to figure out what direction that move is going to be and get on it as fast as possible. In today's video, we're going to look at two of our key in-house models and some important charts and data series that we believe are already starting to give us a lead off as to what direction this next move is going to be for the S&P 500. Before we get started, let me take a minute to just tell you a little bit about us. Asbury Research is a registered investment advisor. We're an RIA. We've been providing both investment research and access to our four model portfolios via managed accounts to both individuals and professional money managers since 2005, which makes this our 21st year in business. We have two levels of research service available. Our Asbury Premium service is our benchmark service that we launched Asbury on back in 2005. It's for more serious investors. It is not an inexpensive service. It includes the latest updates on all of our models. Basically, everything that we do is inside the service. We also give some personal one-on-one instruction via Zoom on how to implement our models and strategies into your own portfolio, whether you're an individual or whether you're managing other people's money. We also have an entry-level service that we started about 18 months ago. It's a Substack newsletter, and here it is. The address, or the URL rather, is asburyresearch.substack.com, and it does not include all of our trading models, but it offers a curated short list of different reports and models from the premium research product, and you get about three reports a week. We're going to go into this in a little bit more detail and show you what those reports look like a little bit later in the video. There's also a free version of the Substack here. So if you have been following us through YouTube, if you like our approach to markets, it's kind of a no-brainer. Just go over here to asburyresearch.substack.com and sign up for the free Substack. You're going to get a free report every week. And it will help to get more acclimated to what we're doing. We're a little different than other firms. We're not talking about MACDs and stochastics here. This is generally models that I've built through my career that are totally data-driven and have helped me to be a better investor and to keep my drawdowns low and just be able to help to manage my money and help our clients to be able to participate in the markets with a lot less risk. You can also have access to our managed accounts. Individual investors, financial advisors, and RIAs can access Asbury Research models and the 4 model portfolios that we have created with those models via managed accounts, SMAs, that are available through Charles Schwab. Financial advisors, RIAs, and other portfolio managers can also access the 4 model portfolios through a TAMP, which is a turnkey asset management program or platform. 2 of our 4 model portfolios are currently outperforming the S&P 500 year to date by 2 to 6%, and all 4 of our model portfolios have significantly smaller drawdowns, lower standard deviations, and lower betas than the S&P 500. Let's change views here for a minute, and let's have a look at those. So the purple line here is AOR, and all of these are hypothetically back-tested. So with all of the risks and all of the disclosures that come with hypothetical backtesting, but this is basically what these model portfolios have been able to do. The purple line down here at the bottom, this is AOR. AOR is an ETF that emulates a 60-40 stock bond portfolio. So you can see what this has done, excuse me, since inception for us in these model portfolios is summer of 2018. The orange line is the S&P 500. The green line is our Asbury Balance portfolio, and our blue line is our Asbury Aggressive. So again, you can see how much more performance that we're able to get out of basically using the 11 sector spiders and the S&P 500, and at times a little bit of leverage, for the performance here over the past 7.5 years. So if you're interested in these, let's go back to the landing page for the premium service, asburyresearch.com. Any questions about any of these models, go to contact and ask us, and we will reach out to you. We have fact sheets on our 4 model portfolios that we would be happy to get together with you and explain. All right, let's start to look at markets a little bit. So what we're going to do in here is go in the research center. This is the paywall, and we're going to go down to the Asbury 6. Most people that track me either on IBD or on Schwab Network or through the Fidelity. By the way, I think it's our 12th annual Fidelity January presentation is going to be on January the 7th. You could go to fidelity.com and you could look around there. I'm not sure of the exact URL, but you can sign up for free. It's an hour presentation that I've been doing now. It's my son Jack and I are kind of the co-presenters for this, but we've been doing this for 12 years now, and we get some very large crowds. 4,000 to 5,000 people sign up for these things, and it's just another way to be able to get a better understanding of our unique approach to markets. So now we're in the Asbury 6 here, and the Asbury 6 is a daily driven gauge of the U.S. stock market's real internal health. I originally created this probably close to 6 or 7 years ago, kept it internal because I didn't want to get faked out the way it's so easy to get faked out in the markets now. When the S&P is up 100 one day and it's down 100 the next, it's very easy to get thrown off your game, even if you've been doing this all your life like I have. So what we did, Jack and I together, is we took all of the tactical tools that I've used throughout my career. We started back testing them in various sets of 3, sets of 5. We tried to pick a diverse group that we would use as kind of a team to keep us on the right side of the market, even when we get the volatility that we seem to be seeing more and more of, where you get these weeks where the market is whipping back and forth, and it's really hard to keep your focus. So what we have here is 6 different six different metrics. They're really diverse metrics. We've got the rate of change in the S&P. We've got relative performance, investor asset flows, volatility, trading volume, and market breadth. When four of these are green, we say that the market's internals are positive or they're bullish. Think of this as kind of a daily EKG for the stock market. When four or more of these turn to red, it means the market is weakening internally. And as long as it stays four or more red, it indicates the market's tiring on the upside and it leads to a move lower. So this is, again, it's kind of an EKG for us to try to get not faked out if the market is having a volatile week, but also to know when the internals under the hood part of the market is starting to weaken, so we know when to start thinking about playing some defense, maybe reducing our equity exposure. Currently all green, which is as positive for the market as it can be. So right now, just tactically, the market's in good shape. The next thing we're going to do as we go back to the research center is we're going to look at another one of our models. It's the SEAF model. SEAF is an acronym. It stands for Sector ETF Asset Flows. And what this does is it tracks the asset. It tracks actually the velocity of assets that are moving around the 11 sector spiders, which if you put them all together, it's the S&P 500. We do it in three different time periods. We do it in trading, which is a week, tactical, which is a month, and strategic, which is a quarter. And then we add the scores up. The lowest scores are the best scores. For example, here in tactical, industrials is number one. That means over the past 21 days, the past month, the fastest, most aggressive money has been going into industrials for that particular time frame. So SEAF is currently overweight XLI, XLK, and XLF right here. I is industrials, K is technology, F is financials, because they're the top three. Through a lot of extensive back testing, we found that we get the best performance when we invest equally in the top three. Since inception in mid-2018, SEAF has significantly outperformed the S&P 500 on an annualized basis, but with a lower maximum drawdown. We're going to have a look at that chart. And there it is. This is the S&P 500 going back to mid-2018 in blue, and the SEAF models in green. Again, hypothetical back testing. Past performance does not equal future performance, but this is what we do to try to determine what really works in the markets. We always talk about how important drawdowns are. A big part of what we do is trying to reduce drawdowns. We have another model called the correction protection model, or the CPM, that was built just to be a means for older investors that are typically a lot more concerned with drawdowns because they're nearing the latter part of their life, the latter part of their investing life, and they don't want to give away a third of what they worked for all their lives because the market had a bad 6-month period or a bad 3-month period sometimes. But this is why it's so important. We had a 34% drawdown during COVID, basically February through April of 2000. So here's what a 30% drawdown looks like in terms of trying to get that back. A 30% drawdown, you need to make 43% back the other way in order to get even. The other part of this that doesn't show in this chart, there's a time element involved here. Investing when you're in your 60s, when you're my age, is like playing football in the fourth quarter. Now the clock is important, where it's not so important in the first half. You can take some chances. In the fourth quarter, you want to be, if you have a lead going into the fourth quarter, which as investors, I hope we all do, you want to try to protect your lead. So it may take you 43% back the other way to try to get that 30% drawdown, try to recover that, but you don't know how long that's going to take. You don't know if that's going to take a year or 2 years or 3 years. And in the meantime, the clock is ticking for you. So this is why we really push the importance of drawdowns so much. Another pretty unique thing about SEAF is it has posted a positive annual return every year since 2018. That's hard to do. Even in 2022, when the S&P was down 19.6, the SEAF was positive by about 8%. So SEAF is sector rotation. The next thing I want to do is get a little bit more into the nitty gritty of some. There's some things going on in the market now that I think are worth our attention. And so we're going to switch views here. And we're going to go to some live charts. And we're going to look at QQQ, which is the ETF that tracks the NASDAQ 100. So here's the QQQ up on top. And down here is the Qs versus SPY. The Qs are important. The Qs are particularly important because technology tends to lead the market both up and down. So we had this big move here in the Qs. Here's the April lows. Huge move here, all the way up to the highs. That's 58%. And then those highs, which were at the end of October, we've been drifting sideways. When the market drifts sideways, it means it doesn't really know what to do next. So it's kind of biding its time. The ranges start to contract as they have here. And you're looking for a breakout either way. And the market isn't confident enough to make that, to make the breakout yet. The ranges keep getting shorter, smaller and smaller. Energy is building up in there. So through the top of this pattern, which would be a rise above, let's call it the Qs, let's call it 627. That would be a breakout higher. Underneath, which is roughly, let's say 610. That would be negative. Look at the relative performance chart down here. That's even drifting sideways. So right now, Qs are underperforming SPY on a 63-day quarterly basis, which is the yellow line here since December 12th, let's say. So this is basically neutral. This isn't telling us much yet. The next thing that we want to do is shift views again, and let's take a look at the AUM in the Qs. This is really important to us. So this is the NDX up here since April, and this is the May 12th breakout on a relative basis where Qs started to outperform, or actually when Qs, the AUM in Qs started to rise above its 63-day moving average, quarterly expansion as of May the 12th. Note that on November the 20th, these assets came back and touched the 63-day moving average. That was a nice bottom here up in NDX. We had another test, similar test on December the 17th. That was another bottom. So right now on a quarterly basis, even though the NDX or the Qs have gone into this triangular pattern, you're still getting quarterly asset expansion. That's a really important thing to pay attention to. Next thing we're going to do along the same lines is we're going to look at the MAG 7. This is MAGS. This is an ETF that tracks the MAG 7. Note the same pattern, but note that it's already broken out of its triangular pattern to the top side and is actually outperforming the S&P 500 or SPY ever since December the 16th. So this may be giving us a sneak preview of what we're going to see over the next week or two. The MAG 7 has been a key driver in the stock market this year. It's all those big AI stocks, the big tech stocks, the NVIDIAs, and others. So this looks like it's giving an upside lean to the market. So we'll have to see what happens. But right now, if MAGS stays out of this pattern, if the Qs follow through and have a similar breakout, it's very likely that they're going to drag the S&P 500 higher. If they can stay in this outperformance state long enough, we'll break 7,000 and we'll have a little bit more work to do on the upside in the first quarter of next year. Two other unrelated, for the most part, charts that I want to look at. This is the 10-year note. TYX, or the 30. This is the CBOE 30-year Treasury Bond Index. It emulates the yield of a 30-year bond. And look what's happening here. We've got this trend line. Sometimes simple blocking and tackling, looking at trend lines, especially when it comes to stuff like interest rates and Forex, which can't be as easily pushed around from day to day as the stock market can. So we have this trend line from May of 25 when we were at 515 in terms of rates. We've been right on top of this line since December the 12th. If we start to break up above it, which means the yield of the 30 years starts trading above 486, 487, we've got a breakout here that could eventually target a move back to 5%. We can speculate on what that might be, on what the catalyst might be in the economy or in the White House or whatever it might be. But keep an eye on rates here, because it looks like long rates, well, it's obvious long rates are trying to break out higher. And this chart is one that we're really focusing on. The last one that I'm going to look at with you is one that we've been talking about here for a long time. So this is Ring, as he tries to type Ring. And we first put an idea out for our subscribers to buy Ring right here on these white arrows. This was August the 6th. We have a 3-step process that we use to determine where opportunity is in the ETF space. One is trend, one is relative outperformance, and the third one is asset expansion. All three of those were met on RING, which I should mention is the iShares MSCI Global Gold Miners ETF. So we had a breakout here. Here's our idea first went out to subscribers, and we got out of that idea right here on the blue arrow. We made 31%, and we actually outperformed the S&P 500 by 31% from here to here. So now we've been sitting on the sidelines for some time, and then we got back into RING right here on the second set of white arrows. So now we're making all-time fresh highs. The next question is, how high can this go? Our minimum upside target here is $81, and we finished at $78.70 on Friday. So this still has legs, and it could go well beyond 81. But this is a key trade for us in the back half of this year. That's frankly made a lot of money, and it could continue to do so as we go into 2026. So let's shift gears here and go back to the landing page. The Asbury 6, our CPM model, our CEF model, our trade ideas like RING are all a part of Asbury Research's premium research service. Contact us right here by the contact tab at asburyresearch.com to request information about service details and pricing. Next, let's take a quick look at our Substack. Our Substack is our entry-level research product, and it's right here. And this was created for those that want to get to know us a little better, maybe before they go into a managed account or before they go into the premium service, which is significantly more expensive. There are a couple of different products within this. The one that we're going to look at right now is our sort report. So the sort report, what we wanted to build here is a way for an investor to look at a lot of different asset classes quickly and determine quantitatively where there is opportunity. So we look at emerging markets, gold, small cap, global equities ex-US, technology, US interest rates, commodities, crude oil, US dollar, crypto, and we measure them by three things: by their trend, by their relative performance, either versus the S&P or versus their benchmark, whatever their benchmark might be, and then the money flows here. Three across that are all green, it indicates that those particular assets are clicking on all three of those criteria. That, for us, is how we take a big swath of different assets and boil it down so we know where we should start to focus on. Right now, it's gold and emerging markets. Those are the two that are clicking on all three cylinders. So that's a part of that service. It's $25 a month. Again, if you like what we're doing and want to kind of put a toe into the pool, this is a really good way to do that. The last thing that we want to talk about today, that I want to talk about today anyways, is the 25th annual Polar Plunge fundraiser. My sons Jack, Brett, and myself are going to be representing Asbury Research in the 25th annual Polar Plunge fundraiser to help raise money for Chicago families who have had some tough times and need some financial help. This will be our third year of participating through Asbury Research. We're going to jump into the icy waters of Lake Michigan on January the 24th, trying to get some donations that will hopefully help change these people's lives. These are people that may have had a debilitating car accident. They're just regular people who live in Chicago, don't have a lot of money. They may have had some tragedy in their family where they don't have anything left. And they're looking for help. So we started doing this. It's fun to do with my family, and it helps us to do something good for the community. If you're interested, you can request more information via the contact tab again at asburyresearch.com, or you could Google Chicago Polar Bear Plunge fundraiser right here, and then you can look for Asbury Research Arctic Aid. You can see we're just starting here, but thanks for listening to that. So there you go. That wraps up our latest Asbury Research Following the Money podcast. Our next one is tentatively scheduled 2 weeks from today on Sunday, Jan the 11th. I hope to see you then. In the meantime, if you have any questions or want any more info on anything that you saw in the video today, you can contact us via the contact tab at asburyresearch.com. Happy New Year to everybody, and go Chicago Bears. See you in 2 weeks.